Rising prices are reshaping everyday shopping lists, turning once affordable staples into costly items. From basics like bread and eggs to essentials such as cooking oil and canned goods, global markets, climate shocks, and supply chain strains are driving steady increases. Here's a closer look at 10 foods that are quickly becoming too expensive to ignore. Number 1. Eggs. Egg prices are being reshaped by a wave of structural pressures that seem likely to keep them high for the foreseeable future. Fresh outbreaks of avian influenza in major laying regions have repeatedly thinned flocks, constricting supply just when demand spikes, especially during holidays or seasonal promotions. Rising energy costs add another stubborn layer. Keeping barns warm for young pullets and refrigerated transport for fresh eggs now come with permanent cost increases that don't easily retreat when fuel prices dip. Processing plants are also dealing with labor shortages that push wages upward. And for many producers, meeting stricter biosecurity standards and more frequent on-site audits from big retail chains means more investment in staff and monitoring systems. And you guessed it, those costs filter through to retail prices. Packaging isn't immune either. It's not just shrinkflation. Cartons may still say 12 eggs, but slight reductions in egg size and carton weight are creeping in, squeezing more cost saving out of the packaging without people noticing right away. On top of that, a handful of states are floating proposals to restrict imports of eggs from producers who don't meet local cage-free welfare standards. That could cut back the flow of cheaper alternatives and leave regional markets more exposed to local supply volatility. Some grassroots efforts are aiming to boost small-scale and local egg operations, arguing they're more resilient. But these producers face higher per-unit costs, higher risk from weather or disease, and generally can't scale fast enough to offset disruptions in large commercial systems. The result is a base cost of egg production that seems stuck higher than a few years ago. With disease risk ongoing, energy pressures baked in, labor costs elevated, packaging wearing down, and policy variability growing, it's tough to see egg prices sliding back to past lows anytime soon. Number 2, coffee. Coffee prices are under pressure from a complex mix of climate shocks, geopolitical shifts, and trade policy moves, factors that are pushing costs upward and threatening long-term affordability across major growing regions. Extreme weather events like droughts, frosts, and floods have slashed harvests and undermined bean quality. Arabica futures have soared as high as $4.40 a pound in early 2025, reflecting a rapid surge tied to climate volatility and dwindling stockpiles. These spikes show little sign of reversing soon. A UN FAO report underscores that environmental stressors have driven coffee prices up nearly 40% in 2024 alone. Global demand continues to swell even as supply tightens. Roasters are cutting back purchases, battling steep futures, high shipping costs, and unpredictable weather. On top of that, a 50 US tariff on Brazilian imports is newly in effect, erecting another barrier to affordable supply, especially for Arabica beans, which Brazil dominates in quality and volume. Retailers, roasters, and even cafes are already raising prices, hoping to cover these rising input costs. Mergers among coffee giants like Keurig Dr. Pepper's $18 billion acquisition of JDE Peet's promise to eventually soften these pressures through efficiency and scale. Analysts expect savings of up to $400 million annually. But for now, inflated wholesale and futures prices are fueling a steady climb in consumer prices. Reports show U.S. retail coffee costs up over 30% year-over-year, with ground roast nearing $8.41 per pound, and premium bags often exceeding $15 or $20. Chemical shifts, weather shocks, tariffs, and shifting supply chains are setting a new higher baseline for coffee prices. While consolidation in the industry may signal future stability, that won't bring immediate relief. For anyone used to a dependable cup at a consistent price, this may be the new normal. Number 3, beef. Beef prices are drifting upward on forces that won't let them settle back down, and this pressure is deepening, not fading. The U.S. cattle herd has shrunk to levels not seen since the early 1950s, just around 86-87 million head nationwide, making the supply pipeline dangerously thin. Ranchers cut herds during years of drought and high feed costs, and rebuilding takes time. Cows have to grow and mature before reaching market weight, so current shortages will echo for years. Droughts, especially in the West and Midwest, have pushed feed and grazing costs so high that many producers had no choice but to downsize, becoming common headlines in 2025. Meanwhile, screwworm infestations in Mexico led to U.S. restrictions on cattle imports, tightening supply further. Consumer demand remains stubbornly strong, defying inflation and recession fears. Ground beef recently exceeded 6 per pound, and steaks are approaching 11-12, a level that was previously unthinkable for many families. Even iconic spots like beloved cheese steak shops are considering dynamic pricing tied directly to beef cost fluctuations to stay afloat. On the supply side, ranchers are cautiously starting to rebuild herds thanks to better rain and good corn yields. But even optimistic forecasts estimate it'll be years before that translates into meaningful increases in beef availability. Globally, imports from Australia and Brazil are rising to fill domestic gaps, but trade tensions and potential tariffs loom over their cost advantage. Meanwhile, consumers have not taken their foot off the gas. Americans keep buying beef regardless of price, perhaps due to cultural habits and perceived nutritional value. Climate change layers in another dimension, making drought cycles more unpredictable, raising feed costs long-term and making this whole squeeze structurally embedded. Meat processors are squeezed too. Margins collapse when cattle are scarce and expensive. This tug-of-war between persistent demand and constrained supply points to a future where beef remains among the least affordable centerpiece proteins for years to come, maybe indefinitely. Number 4, bread. The price of bread has become one of the clearest signals of how fragile global food systems really are. Wheat, the foundation for nearly every type of bread, is facing constant pressure from climate extremes, shifting trade policies, and rising production costs. Several of the world's largest exporters, from the US to Russia and Ukraine, have been hit by repeated droughts, floods, and heat waves that cut yields dramatically. When one harvest fails in a key region, global buyers scramble to secure supplies from elsewhere, pushing prices higher across the board. Export bans and restrictions, often introduced to protect domestic markets, add another layer of volatility. India, for instance, has repeatedly adjusted its wheat export policies depending on local harvest outcomes, which shakes confidence in long-term supply chains. Even when wheat makes it to the mill, costs don't ease. Energy prices directly affect milling and baking because ovens, industrial mixers, and large-scale refrigeration all run on costly electricity and gas. Transportation and shipping add further expense, especially when global fuel prices are high or supply chains are disrupted by conflict or logistical bottlenecks. The packaging industry has also seen sharp cost hikes. Everything from paper bags to plastic wrappers has gone up, making even budget loaves pricier. Urban bakeries and supermarket chains have reported raising prices multiple times in a single year, while artisanal bread makers who often rely on specialty flours even sharper increases. Some chains have turned to shrinkflation, keeping prices steady but making loaves smaller or lighter, which consumers notice only gradually. At the same time, demand for bread remains relatively inelastic. It's a staple in diets across the globe, so people buy it even when it gets expensive. That steady demand combined with stressed supply leaves little room for prices to retreat. On a global scale, organizations monitoring food security warned that bread will remain at the center of affordability concerns for years. Rising fertilizer costs, unstable weather, and geopolitical tensions create a cycle where wheat rarely has a chance to stabilize, meaning bread prices tend to ratchet upward step by step. Once production costs reset at higher levels, bakeries and retailers rarely return to older prices. This pattern suggests that bread, once the most basic and dependable food, is increasingly shifting into a category where affordability is no longer guaranteed. Number 5, dairy products. Dairy costs are heading upward, driven by a tight squeeze between increasing supply and even stronger pressures across the global market. Milk production has been climbing as herd sizes grow and yields improve, supporting an all-milk price above $20 per 100 weight in 2025. Forecasts suggest only a slight dip the following year as output continues to outpace domestic demand. Export demand for butter, cheese, and whey has been holding prices firm for now. But growing import competition and shifting export volumes could soon unsettle that balance. This leaves dairy prices elevated, offering only a short-term cushion before the long-term cost drivers reassert themselves. Weekly market data shows that butter, cheese, and non-fat dry milk remain costly. Butter is hovering near $2 per pound. Cheese averages close to $180. Non-fat dry milk trades around $120 and dry whey stays tight at just above $50. Inventories of butter are shrinking. International demand remains particularly strong for cheese, and retail sales continue to hold up even as seasonal production slows. Spot markets react quickly to these pressures. Cheddar blocks can surge several cents in a week, while butter prices jump on even small shifts in supply, reflecting the volatility tied to both domestic production and trade tensions. Official projections have been revised lower in some categories, with all milk near $21, cheese at around $179, butter near $240, and dry milk at about $120. Yet at the same time, production forecasts are edging higher, signaling heavier long-term supply pressure. Underlying costs keep climbing steeply. Global milk production costs rose more than 10% in the past few years, with most of the increase since 2021. Feed, fertilizer, transport, labor, interest rates, extreme weather, and geopolitical instability have all pushed costs to new levels. Policy instability adds another layer of uncertainty. The lapse of major farm legislation has left subsidies and disaster relief in limbo, with some analysts warning of a potential dairy cliff if renewed support stalls. Updates to federal milk pricing formulas are also under debate, aiming to modernize policies, but likely shifting burdens unevenly across farmers and processors. Meanwhile, U.S. dairy farms are disappearing at a rapid pace. Only a fraction remain compared to the 1970s. While most milk today comes from large-scale operations housing thousands of cows, this consolidation raises concerns about rural decline and the system's resilience to disruptions. Major retailers expect grocery inflation to persist well into the future. Even if some items ease, dairy products are projected to hold steady or keep rising. Milk, butter, cheese, yogurt, and other staples now face a future where short-term export demand props up prices. But structural costs, policy gaps, industry consolidation, and inflationary pressures ensure that dairy will remain one of the hardest categories to see real relief on price tags. Number 6. Rice. Rice shows a dual nature. In some markets, it's becoming a steep cost staple, while in others, abundant supply is pulling prices downward. In Japan, domestic rice prices have doubled from last year, pushing the government to release emergency stockpiles in an attempt to stabilize the market. A 5-kilo bag that once cost roughly $13 now runs close to $24, prompting leaders to treat rice as a pivotal political issue amid looming elections. Reversing decades-long policies, Tokyo is now encouraging higher rice production from around 2027, aiming to both meet domestic demand and eventually export up to 350,000 tons by 2030. Efforts like diverting stockpiled rice to school lunches and healthcare institutions are underway, but market impact remains muted. Meanwhile, iconic regional varieties like India's Goindab hog rice have doubled in retail price over 7 months due to tight supply and surging demand from South India and the Middle East. Contrast this with global trends. Oversupply from record harvests has driven global rice prices to their lowest in 8 years. Benchmark rice prices, such as Thai broken white rice, have dropped around 26 since late 2024, and the UN Food and Agriculture Organization's rice price index is down 13 in 2025. India's record-breaking output, along with rising yields from Thailand and Vietnam, has created a deep surplus, leading to sharp declines in export markets. In the USA, rice futures have fallen to lows of about $12.50 per 100 weight, roughly 30 below 2023 highs, as global overproduction exerts pressure on domestic farm prices. U.S. rice farmers are also watching record production from India flood the market, with Indian policies like subsidies and supportive infrastructure continuing to tilt pricing downward. Still, there are warning signs ahead. India's release of over 20 million tons from reserve stocks may continue to pressure, but weather still plays a wild card. Monsoon fluctuations could curb production unexpectedly in changing climates. Crucial rice regions like Vietnam and Thailand face yield risks. Rising temperatures may cut output by several percent per degree of warming. In West Africa, staple rice prices remain volatile, as highlighted by a regional price tracking Jollof index, reflecting deep affordability challenges in Nigeria and Ghana. All told, rice's long-term price outlook is split. Oversupply and strong competition keep it cheap in many markets, especially where exports flood the market. But localized shortages, cultural importance, and policy shifts, particularly in places like Japan and South India, can drive prices sharply upward. Structurally, markets will likely remain uneven. Export-dependent regions may enjoy relief, while others grapple with scarcity-driven spikes. Number 7. Cooking oil. Cooking oil costs are trending upward on multiple fronts, and the mix of factors shaping this trend points to durable, long-term price pressure. The FAO's Vegetable Oils Price Index rose about 18% year-over-year by June 2025, underlining how even broadly traded blends, palm, rapeseed, soybean, are becoming more costly. Palm oil and rapeseed climbed steadily, while prices for sunflower oil softened thanks to increased production in the Black Sea region. Recent months haven't eased the rise overall as the index ticked upward from May through June. Organic oils are not immune. Olive oil prices more than doubled since 2021, driven by persistent heat waves, drought, pests, and crop theft in Europe that sharply shrank output. On the tropical front, coconut oil has vaulted to record highs. Mature palms are failing to produce, replanting lags, weather swings disrupt yields, and demand for coconut-derived foods and personal care products keeps climbing. Seasonal shortages pushed coconut oil prices in mid-2025 to near $3,000 per metric ton in some markets, even as broader vegetable oil stocks remain tight. Supply projections for palm oil, which accounts for over half of global vegetable oil consumption, show growing alarm. Aging plantations in Indonesia and Malaysia aren't being replanted fast enough, risking a potential 20% export drop by 2030, and that would ripple through pricing of all substitutes like soy and sunflower oil. In India, domestic rapeseed oil now costs over a third more than a year ago, prompting major canola oil imports for the first time in nearly 5 years. That shift reinforces how tightly local markets can react to price swings when staple oils become costly. Trade policy remains another swing factor. New U.S. tariffs on Canadian canola oil threaten to drive up fryer costs across North American restaurants, where canola remains a preferred medium for French fries. Simultaneously, rising crude oil prices driven by geopolitical tensions in the Middle East and shifting biofuel mandates push up transportation and processing costs for cooking oils while spurring demand for vegetable oil-based fuels, adding extra pressure into already tight supply chains. Putting it all together, vegetable and specialty oils face a potent mix of structural constraints, aging plantations, climate-driven harvest disruptions, surging demand in food and energy sectors, trade upheaval, and rising logistics costs. That means grocery shelf prices for cooking oil may remain elevated, turning even basic household essentials like frying oil into items that feel less affordable over time. Number 8. Potatoes. Potato prices are being driven by a volatile mix of climate shocks, supply chain strains, and shifting market dynamics, creating a long-term squeeze that's likely to hold retail prices higher even as conditions evolve. In regions of Europe and North America, heat waves and drought have slashed yields, while heavy rains and flooding and others continue to disrupt planting and harvest windows, inflating costs year after year. Analysts now speak of climate-flable staples like potatoes are among the hardest hit, repeatedly surging when weather turns extreme. In Russia, potato prices have nearly tripled compared to the previous year, touching historic highs and prompting government action to ease the burden. The crisis revealed how a staple so embedded in national diets can act as an economic barometer and how quickly shortages ripple into social and political pressure. Globally, however, wholesale potato prices have fallen to 4-year lows, weighed down by oversupply, reduced demand, and ample contracted volumes. Though market analysts caution those dips may not last as fundamentals don't fully support such steep declines. Growers are squeezed by soaring input costs, seeds, fuel, fertilizer, storage, labor, all eating into profit margins that processors and retailers continue to capture disproportionately, widening the gap between what farmers earn and what consumers pay. In North America, planting acres are declining amid weaker demand, water constraints, and processing uncertainties, meaning producers may plant the fewest potatoes in decades this year. Processors in the U.S. frozen food sector are even facing lawsuits alleging price fixing and uncompetitive practices that drove up the cost of fries and hash browns despite lower input expenses. New potato varieties resistant to pests like the potato cyst nematode are being rolled out in places like Kenya, promising to protect yields and bolster food security. But such innovations take time to scale and won't immediately ease global shortages or price pressures. In Ireland and much of Europe, early crop oversupply has brought momentary relief, but oversupply doesn't guarantee durable affordability when storage, processing, and trade remain complex and costly. Even snack foods made from potatoes are under strain. Small price hikes or shrinkflation in chip bags risk eroding consumer trust and brand loyalty at the shelf. That delicate balance means farmers, processors, and retailers alike are navigating pressure from both ends: higher production costs and heightened consumer scrutiny. Putting it all together, potatoes are caught in a cycle where climate volatility, cost inflation, supply chain churn, and structural market imbalances push prices up even when temporary relief appears. In many markets, what was once a cheap, dependable staple is increasingly riding a wave of structural upward pressure, with affordability likely to erode gradually over time. Number 9. Sugar. Sugar's price trajectory is set to keep shifting long-term, with short-term fluctuations often masking deeper structural shifts. Brazil, the world's biggest sugar producer, is facing growing weather-related threats to its cane harvests. In recent weeks, prices surged nearly 30% amid fears that Brazil's output will fall short and tighten global supply, with traders pointing to prolonged pressure from adverse weather and logistical obstacles. At the same time, the USDA forecasts a record global sugar production of nearly 189 million metric tons for 2025-26, a 4.7% increase year-on-year, with stocks rising, suggesting a looming surplus. These opposing forces, production gains on one side, supply risks on the other, are setting the stage for volatile pricing. In Europe, a leading sugar producer posted an 85% drop in first-quarter profits due to plummeting EU sugar prices squeezed by cheap imports. That region expects price relief later in the year as beet planting areas shrink, but that assumes tighter markets ahead. India's Maharashtra state reported a 29 lakh-ton plunge in sugar output from the previous year as the crushing season shortened dramatically and yields declined due to erratic monsoon behavior. This localized shortfall is feeding concerns over supply in global markets, especially given India's growing role as an exporter. Back in the U.S., the USDA projects a slight year-over-year dip in total sugar production in 2025 to IA6, as gains in cane output barely offset declines in beet production. Still, record-high beginning stocks are keeping inventories elevated, offering temporary cushion against sharp price climbs. Meanwhile, any shift toward cane-sweetened products, even limited ones like a proposed cane sugar version of a popular soda, could redirect demand significantly. Experts warned that such a move would raise pressure on already tight sugar supply chains and could push prices higher, especially given U.S. tariff constraints and quota systems. Forecast models remain divided. Some bullish analyses see potential for 2025 sugar prices to rise dramatically, perhaps even by 50 to 60%. If adverse weather or policy shocks hit key growing regions, others highlight that current production forecasts and strong inventory buffers should hold back major price spikes, at least in the near term. Taken together, sugar's future looks unpredictable. Abundant global supply may keep basic prices in check for now, but recurring local shortfalls, geopolitical trade filters, emerging shifts in sweetener preferences, and weather-driven volatility suggest long-term risk. That means sugar, once a mostly stable pantry staple, could face renewed cycles of sharp price jumps depending on weather, policy, and shifting demand. Number 10. Canned goods. Canned goods are starting to shed their reputation as the affordable long-term pantry standby. A wave of recent developments spells higher prices and tighter availability, making this category one to watch closely. First and foremost, steel tariffs have more than doubled, moving from 25 to 50. And this isn't a remote business cost. It directly affects tin-coated steel sheets used in nearly all canned food packaging. With over 7,080 of tin plate steel imported into the U.S., that cost is cascading down to manufacturers who may have to raise prices by 9 to 15 per can. That could mean an extra 30 cents for each standard size item, translating into real pinch for consumers stocking basics like beans, soups, tuna, and fruit. Processing giants warned that unless domestic production ramps up, which could take years, the higher prices could persist, disrupting shopping habits and supply chain dynamics. Simultaneously, industry insiders report that major players are already starting to raise prices on select canned items. One brand raised costs for canned pineapples, and analysts suggest that similar increases could ripple through other canned fruits, vegetables, soups, and proteins. The cumulative impact may follow broader badge inflation trends where cost-sensitive households begin rationing or substituting canned staples. Emerging market analyses suggest that the global canned goods market is set to grow significantly, adding more than USD 70 billion between now and 2028. That signals demand strength but also ongoing structural pressures as packaging costs, supply chain shifts, and inflation persist. The growth rate forecast of about 5 CAGR may reflect not just volume increases but also price inflation baked into future revenue estimates. Taken together, canned goods face a multi-pronged cost squeeze: metals tariffs, packaging inflation, and supply chain stress. The result is a potential loss of their role as a low-cost, long-shelf life safety net. For anyone counting on canned items for both convenience and budget buffering, the era of easy, dependable affordability could be nearing its end.